Brad Thomas, so good of you to be here. Thanks for coming to talk with us.
It's great to see everyone today.
All right. You and I did get to talk a little bit at the Stansberry conference just for a few minutes. And, we just talked about REITs for a few minutes and you gave us some good points, but I'm hoping we can get a little deeper into it today. But maybe since you're a new guest to our audience, you can tell us, why was I talking to you about REITs? Tell us a little bit about your background and how you got to where you are now.
Sure. Well, I guess right out of college, I decided I wanted to pursue a career in real estate. And My mother was actually in real estate, so maybe that was an inspiration. Some of the other family was in real estate, but always knew that I could create a lot of wealth in real
Mhm.
estate. And so I started out really in the trenches, Dan, just started to help lease properties. I became a leasing agent and I did that for a couple of years. And I found out that, it's had a, nice income, but the ones that were really making the money were the landlords, the ones that actually received the rent checks. So I decided to pursue a career in real estate development and building my own buildings and assembling my own portfolio. And so I did that started out small. Started picking a lot of small companies and really, and that's really where I became a research analyst at that point, because I would research these companies. A lot of them were small companies to determine if they were going to be, tenants in my shopping centers or my freestanding properties. And so one of the first clients I had was a company called Advance Auto Parts. And Advance Auto Parts at the time was privately held. So I tried to do as much research on the company as I could to determine if they were going to be a sustainable rent payer or tenant. And so I drove up to Roanoke, Virginia, to meet with a management team, and I decided to build my first building in Lawrence, South Carolina, a little small town here in South Carolina. But coincidentally, that's where I went to college, in the same town. And um, and I built the first store. Then I did a second store, and ended up building close to 50 stores for Advance Auto. I went into South Carolina, North Carolina, Georgia, and parts of Alabama, and really decided to build a cookie cutter type of business where I would just rinse and repeat and build these buildings, typically in front of a Walmart or close to a Walmart, and hired the architects and engineers. And then I decided to pursue some other tenants. I wanted to diversify, and I started to build for Blockbuster Video. And at the time, they were a very small, scrappy little video operation. Of course, you know the story. Wayne Huizinga ended up putting some money behind Blockbuster and scaled that business nationwide. And then I started to build for other companies. A company called Dollar General and Dollar Tree and Family Dollar and PetSmart and Walmart, McDonald's, Barnes and Noble. Built the local store, Barnes and Noble, here in my hometown, and actually my books are now in the Barnes and Noble store, which was kind of full circle, somewhat surreal for me to now have my books in a Barnes and Noble that I built. Um, and so I've watched, I've learned a lot over the last 2 or 3 decades. But the Great Recession was really the opportunity for me, believe it or not, because I ended up losing a lot of my net worth due to a bad business partnership, and also as a result of the Great Recession, which of course all banks were closed, and a lot of banks failed, really put the development business out of business. So I started to become a research analyst, really doing some of the same thing that I'm doing now for Wide Moat Research. I analyze these companies to determine if they were companies that I would want to rent to, but now invest in. And so that's kind of what happened. It was really I built up a pretty nice fortune in real estate, but ended up losing most of it. And I started my career in the intellectual property business, and which is really what I love, and that's my passion. And of course, our business extends beyond just real estate. We now cover a lot of companies like REITs, real estate investment trusts, who are by law forced to pay out dividends to investors. We cover a lot of different sectors, from business development companies, that's BDCs, banks, utilities, home builders, asset managers, the private equity players that you're probably familiar with. And we cover all the different types of parts of the capital stack. So not only just equity, but bonds and preferreds, So we really try to create a business model in which the individual investor can build their portfolio off of all of our research that we publish.
Sounds good. I noticed that I was just grabbing some charts in Bloomberg before we started recording, um, because real estate, it's been a difficult subject for a lot of investors over the past few years. And by that, maybe all I mean is that there have been a lot of negative headlines, mostly around commercial real estate. Um, and it has struggled. I was looking at the sector spider, the S&P 500 real estate ETF over. Just grabbed a quick chart last 5 years, so it's up like 14%, and the S&P 500 has almost doubled in that period. So you can see the struggles there that some people may have had. How do you feel right now? Do you feel right now, after this period of some amount of struggle, and there's also a lot of debt hanging out there that could affect valuations of certain types of properties? Um, there's a couple questions here. One of them is, what types of real estate properties maybe aren't as troubled as the rest? And in those troubled ones, as a value investor, I'm thinking, man, there's got to be some really juicy stuff in there. There's got to be some bargains in there at some point. If things are that bad for that long, there's got to be bargains, haven't there? So you can start with either one of those, untroubled sectors in real estate, or bargains in the troubled, whichever you like. We're going to get to both of them eventually. So.
Okay. Well, let's start with the negative. Let's start with the negative sentiment. You talked about debt maturities. We've seen a lot of the headlines with commercial real estate. Debt maturities. We've seen a lot of headlines about rising rates and how that's impacting commercial real estate. And certainly we've seen how the office sector is just dead. And you should not invest in the office sector. And I think those are the three biggest, I would call, kind of overhangs that we have for the real estate investment trust. Now, I want to really debunk those three.
All right.
For REITs. Number one, let's talk with number one was the debt maturities. And there are some debt maturities out there to be concerned about. Most of those are on the private side. Most of I was a developer for over 20 years. So I would definitely be in that category of, I would be scared and concerned and fearful if I were a young developer like I once was and had some debt maturing, which we know is going to be repriced at a much higher rate than I took these loans out, especially during or before COVID. So I think certainly debt maturities are a problem for some of the private developers, but for most of the equity REITs that we cover, and these are companies that I would consider, extremely large. They're not, these aren't small caps. They're, some of which are S&P 500 companies like Realty Income or Simon Property Group or Prologis, all of which, by the way, have fortress balance sheet. They're all A-rated balance sheets, which obviously these rating agencies do a pretty good job at assessing the risk of these companies. And we know those companies don't have those problems of short-term debt maturities. So they've been able to manage the capital stack very, very well. Again, in terms of the private market, there's still some struggling private developers, especially in the office sector, where you'll be seeing these valuations really get destroyed in office. So if I was an owner of an office building, you may have seen your net worth in your office buildings drop 50% over the last 3 to 4 years. So when that loan matures, the bank is definitely going to be looking hard at your property and willing to see some equity or potentially hand those keys back to the lender. So those problems do exist, not as much on the equity REIT side. Now let's go over to the next category we talked about was rising rates. Certainly, REITs aren't immune to rate increases. That's absolutely true. But remember, cap rates adjust. Cap rates are the cost of, for those of you who aren't familiar with the cap rate, it's essentially the formula is your net income of the property divided by the purchase price. That is your cap rate. And so we've seen as interest rates have gone up, we've seen how the real estate market has shifted. Cap rates have come up as well. So the most important thing to consider with REITs, and really this goes with any business, frankly, is looking at how that company is able to return capital and what is that weighted average cost of capital. And that's something we do a lot of within our research is we analyze these companies at a very granular level to determine their weighted average cost of capital and what is their yield, their year one acquisition cap rates. And in other words, we want to see a spread. We want to see a margin of safety between that acquisition, that cap rate, and that cost of capital. And we're seeing that with a lot of these companies, again, not most, but certainly with the real estate investment trust, the bigger companies that I mentioned. I'll mention Realty Income again, because we're going to talk about valuation in a minute, and Realty Income is certainly in that attractive area. But you take a Realty Income, for example, were they able to acquire properties at cap rates of around 7.5, and their weighted average cost of capital, which by the way includes their free cash flow after dividends, is something in the range of about 4.5 to 5%. So you're still seeing the difference between that weighted average cost of capital and that cap rate, which is effectively around 200 basis points, which is certainly a nice spread to which is basically your profits. That's how a company generates their profits between their cost of capital and their acquisitions. So again, REITs have been impacted, but we've seen those adjustments in cap rates. And so now we're seeing very favorable earnings. Now we're just finishing up the third quarter earnings a few weeks ago. And again, a lot of the REITs have generated, they certainly missed their earnings. They've hit their earnings, and many of them have increased their earnings guidance for year end, which means they're still able to continue to develop very positive investment spreads and grow their profits. And REITs, we call that adjustable funds from operations, not earnings per share, which is your traditional metric we use for C corporations. So again, I'm painting this kind of as a very broader brush, because there are some companies that we do get concerned about, and we avoid a lot of those companies that aren't able to generate sustainable investment spreads. And again, that applies to REITs, BDCs, or essentially any company within our coverage spectrum. We want to see a track record of sustainable and predictable earnings and dividend growth, I might add. And last but not least, and this is the most important reason I think most investors today invest in REITs, is because of that dividend. And again, by law, REITs must pay out at least 90% of their taxable income. Most pay out 100% of their taxable income. And so we're seeing these dividends still continue to increase. Now, we've learned a lot during COVID. And of course, this is what I would refer to as the black swan event that I certainly couldn't have predicted. But what's interesting, like prior to COVID, we actually looked at some of these sectors like office and like malls. And we knew that with malls specifically, we were not extremely bullish in the mall sector leading into COVID, because a lot of these mall REITs had very high dividends. Some paid out like 13, 14, 15% dividend yields. And we knew these companies weren't sustainable. Their payout ratios were very high. We call those sucker yields when you hit 100% or higher payout ratio for these dividends. And so we avoided a lot of that going into the pandemic. And thankfully, again, we didn't know the pandemic was going to hit, but given the fact that we knew the mall sector was way oversupplied, and the fact that a lot of these mall companies, mall REITs, were not covering their dividend, we were able to avoid that. Same goes for the office sector. The office sector has really not generated a whole lot of growth over time. We look at the sector going way back. Now, I do like some of the specialty sectors in office. I like medical office buildings, for example. Those are very sustainable business models. Everyone has to go to the doctor. So these doctors are going to show up and they're going to pay rent. And we like that particular sector. Another category we like within office, again, another specialty category, is life science. That's where that's where cancer is cured. That's where all of the innovative technology is there with all these life science companies. So there's been a lot more growth. So we are looking very closely at the supply of life science, but I think there's definitely some opportunity. There's a company called Alexandria, which is one of the largest life science REITs and landlords in the country, and we're very bullish in that sector. Again, looking at all the fundamentals of that company, including their balance sheet, which they have a very, very high quality, very disciplined balance sheet and management team. So I touched on rising rates. I touched on some of the property sectors, and I guess the last thing I want to mention is, I think in terms of REITs, and again, a lot of people when they look at REITs, they don't really understand kind of the differences between a REIT and just owning real estate. But again, I think you're seeing with REITs, for the most part, we've got very good quality management teams. Not all companies, and we certainly call those management teams out when they're not when they aren't delivering for investors and not aligning with investors. But the great thing we have about REITs is because of that transparency. As a private developer, one of my problems was I could never get financial statements and frankly, tax returns out of my business partner. And it was very difficult. And so with public companies like REITs, publicly traded on the various exchanges, the SEC requires that. So obviously having quarterly reports and annual reports, and certainly dividends are a terrific indicator. We like to see dividend increases. You've probably heard me say this before, but the safest dividend is the one that's just been raised. So when a company raises that dividend and they've got a low payout ratio, that's a pretty good signal that this company is aligned with the individual investor. Because obviously dividend growth is extremely important to us and how we analyze companies. So I hope I touched on all that. Let me know if I didn't. And I'm happy to touch on some property sections. As you mentioned, Dan, look, of the last 10 years, we've seen just an enormous amount, almost an explosion in the REIT space in terms of the different types of property sectors that we cover that we never would have imagined the individual investor could be able to access today. So I'm happy to touch on any of those as well.
Yeah, I'd be interested to hear some of those as well. And for a second, you brought my mind back to pre-COVID days, which was nice for a change, because it seems like everything since then has changed. But you're right about the malls. I mean, those were in trouble. A lot of them were in trouble previously. But yeah, I'd be curious to hear some of those other sectors that you're talking about. I mean, already medical office, life science office. I'm sure people are intrigued by that. But yeah, I'm curious what other ones you might have.
Sure. Well, one that's really interesting, and this one's a lot of volatility due to political ramifications, is the cannabis space. Of course, we still have no federal mandate, federal laws for cannabis REITs or cannabis in general, but we do have REITs. What's interesting about cannabis, there's only one cannabis REIT that is listed on the New York Stock Exchange, and somehow just through a really maybe they got in at the right time. I think it's Innovative Industrial Properties. The ticker symbol is IIPR. They were the first mover advantage. They did list on the New York Stock Exchange, but the window closed, and now all the other cannabis REITs are either NASDAQ or actually over the counter as well. And but there's some Canadian listings as well. But anyway, that sector is actually growing. Again, there's a lot of volatility. There's tremendous growth in cannabis prior to COVID. In 2014, 15, you were just seeing an explosion in the number of cannabis facilities across the U.S. And as the number of states have opened up and continue to open up, the legalization of their states, we've seen more growth in that sector. So, but again, that's a extremely specialized and more volatile sector, but that's one name. Certainly cell towers, those companies came about really 2008, 2009. American Tower is one of the largest. You have Crown Castle and you have SBAC Communications. So there's three, what I would call pure play tower REITs. And of course, the demand in 5G, it's just insatiable. And so we're seeing the continued growth there. Now there's obviously the risk of satellite and Elon Musk and opening up his technology. But I do believe cell towers, that business model is certainly going to be sustainable, at least in the short to the midterm. Data centers, amazing business. AI has certainly been the fuel. I would argue that data centers are mission critical to AI. All of us, cover the different AI within our franchises, and certainly these data center REITs are the driving forces for all of that technology. So data centers have done extremely well. We've done extremely well covering those companies. Moving over to another sector, which is really a lot more boring, is the farming sector. There are two farming REITs, but again, land is a core asset class, and I think it's important for investors to consider some allocation to farmland. think Mark Twain said it, or maybe somebody else said it, but land, they're not making it anymore. Maybe it's Will Rogers. I think I'll credit that to Will Rogers. But at any rate, land, they're not making it anymore. And so certainly there's farmland is definitely an asset class that's important. Another sector that kind of ties into that land play is ground leases. There's one REIT specifically called Safehold, ticker symbol SAFE, SAFE. And that company, all they do is invest in ground, but they have leases. So they're obviously ground leases. As a developer, I built several buildings on underlying ground leases where I didn't own the land. I just owned the building. And that's an interesting business model as well that really never existed. One of the sectors that we really we were early movers in covering is the casino sector. And I know, Dan, you and I met in Las Vegas at one of the properties there, and in Las Vegas. And what's interesting about the gaming or casino sector is during economic downturns and primarily recessions, actually these casinos have held up pretty well. We've gone back and looked at some of the studies even during the Great Recession where I struggled and started my new career in writing. But you're seeing a lot of those companies have actually performed fairly well even during economic downturns. And perhaps that's part of the psychology of especially us Americans, where maybe when we lose money, we just try to go to the casinos and gamble and make it back when we lose our job. I hope not, but I think there's certainly some statistics that prove that. And then we go to COVID, which has really been an interesting test case for us. So you think about, during COVID, I don't think anybody went to Las Vegas. The hotels were vacant, casinos were vacant. But what's really interesting is, again, these casino REITs are net lease properties. So, essentially you're a landlord to Caesar's Palace. So you don't operate it, but you just collect a rent check from Caesars or from MGM or a number of these other casinos. And so one company in particular, Vici Properties, VICI is the ticker, they collected 100% of their rent during COVID. So, and of course, you looked at the share price of the company, and they were just way down, 50%, 60%, just getting beaten up like everything real estate related, because everybody was at their home and nobody was going to casinos or malls or shopping centers or what have you. And so, the sentiment was really way down, but yet, we knew that the rent checks were going to keep coming in. So eventually the value would catch up with that, and we would get back to normal, and we did. And so again, they had 100% rent collection during COVID and continue to increase, which means they continue to increase their earnings or their profits, and frankly, their dividends, even during COVID. So now the office sector obviously was not that favorable. And now we're still seeing a continuation of what I think is an acceleration of the migration of jobs from these urban markets, these gateway markets, and specifically I'm referring to New York City and San Francisco. We're still seeing that acceleration and demand towards places like Miami or West Palm Beach. I think in terms of other sectors, we have fiber was interesting, which is kind of an offshoot of towers. In the healthcare sector, we've got a number of subsectors: skilled nursing, senior housing. I mentioned life science, medical office buildings, memory care. There's just a number of ways to invest or play the healthcare card. And obviously, what's driving a lot of the healthcare REITs, especially the senior housing, is the aging population, or what I refer to and many refer to as the silver tsunami. And then piggybacking on the silver tsunami, this one sector I really like a lot is manufactured housing. Not mobile home parks. There's definitely a difference. I live in South Carolina. There are a lot of mobile home parks in South Carolina. These are mobile homes are typically older. They're not built in factories. They're not as higher quality. They don't have curb and gutter and amenities in these subdivisions. Whereas manufactured housing, typically you're going to find those communities, say over in Hilton Head, South Carolina, or maybe down in all over the state of Florida, and a lot of retiree markets. You're going to have these manufactured housing properties. And what's interesting about the manufactured housing sector is a lot of these customers, they own their houses, their manufactured houses, and they lease the land. So it's essentially a ground lease like type setup, where as the landlord, you're just collecting very stable income off the land. And that's very attractive because you don't have as much operational expenses as you would for a traditional like single family rental, for example. So manufactured housing is a fairly new sector, been around 10 years, and there's 3 different companies that we cover within manufactured housing. So anyway, I'm happy to touch on any others, but those are some new property sectors. I wouldn't be surprised to see some others. In fact, I don't want to give it away, but we've got a new company that we're covering for Wide Moat that is kind of a new real estate sector that I think eventually could find its way to the REIT sector.
Interesting. Okay, I know you have paying subscribers, so I won't ask what it is. Sounds like real estate's to a large degree is as technology driven as everything else to me.
It's interesting, Dan. I just published a book earlier this year called REITs for Dummies, which I'd love for you to have a copy of. If you don't have one, direct message me, you and Corey. But within that book, if you ever read a dummies book, you can actually put together these icons for the book, which help you remember things throughout the book. And one of the things I decided to do with REITs for Dummies is include a new icon to the dummy series, which is called prop tech. So every time it's interesting because every sector that I wrote about, every REIT, almost every REIT has a prop tech type of business model. For example, in multifamily, these companies like Mid-America Property Communities or Camden Properties, they have all invested in various prop tech businesses, which helps them in various categories, such as like leasing. They do now a lot of virtual leasing. A lot of the payments are made online. I mean, just an enormous amount of technology, and that's advanced a lot during COVID because people wanted to go out and rent houses or look at or pay their bills or communicate with their property managers, and so we're seeing that continue to accelerate. And really, I like to see any company that makes their businesses more efficient utilizing technology, because obviously that's going to earn more money for investors. So I definitely think all of these categories, I mean, obviously it's a given that data centers have prop tech. I mean, that's what they're in the technology business. But almost every category has some element of prop tech. Self-storage is another great example. Really, I think the early movers in prop tech were the self-storage companies like Public Storage or CubeSmart or Extra Space. 10 years ago, when you rented a storage building, you probably went to your Yellow Pages if you're old enough to know what that means, like me. And you remember you had the Yellow Pages, and you just go to the AAA storage, and that's where you would find your storage facility close by to your home. But now it's just all the technology. You've got these apps. These REITs have their 24-hour call centers, and just a massive amount of technology. They can actually price. They price their businesses based on all the competition in the market, and they utilize all that technology. So just a tremendous amount of ways that these companies can be innovative. And I'm also seeing a lot of these REITs invest or partner with AI companies. For example, there's one company that has close to I think over 5,000 leases in their portfolio. Well, think of the time required to go have 5 or 10 people to analyze each of these leases and put all the data into the computer. Well, now because of AI, these companies are able to basically scan those leases and everything goes in there, and it's a lot more efficient for these companies as they grow their portfolios to utilize AI to look for the documents they need or scan those items. So you're right. I mean, technology has just really been amazing to see, and the continuation of that going forward. I think AI is going to be really interesting to see going forward, and how that applies to the commercial real estate business. I like to tell people a lot, if you're going to invest in technology, the way we play it is we kind of call it the trifecta approach, which is kind of the 3 legs to the stool. So first off, we like the cell tower sector. We think that's an area that has tremendous growth, double digit, potentially low double digit, growth or earnings growth potential for those businesses.
Wow.
Then we go to the data center sector. Again, needless to say, that's AI driven, and there's tremendous demand with data. again, leading into that second leg on the stool. And again, the third leg to that stool, part of that, closing out that trifecta, is the logistics or warehouses, and these are the companies that store the property, store the goods for the last mile over to the consumer. This is companies like Amazon, Home Depot, Best Buy. They all have logistics facilities, and again, there's a lot of technology, a lot of prop tech investments in those businesses, and that's why you're seeing still a continuation of those very strong growth characteristics. Again, very high single digits or low double digit growth forecasts for many of these companies, warehouse companies. So if you're going to overweight your real estate, your REIT portfolio, I would definitely consider kind of what I call that trifecta approach, and trying to diversify within each of those three, what I think are critical, mission critical property sectors.
All right. And you think that obviously you're like the REIT advocate here, but I asked you in Las Vegas, what are some bullet points, that can, if you were just trying to convince somebody, sort of an elevator pitch, you should have REITs in your portfolio. I feel like you've done it at length here, because you've come at it from technology, and you've shown us, the various sectors that you like: health, cell towers, data centers, etc. Like, what if I've never heard of REITs? I'm absolutely certain, Brad, that somebody's listening to this who's saying, and maybe even a lot of folks are saying, REITs? I don't think I own any REITs. What, and you've mentioned, they're required to pay out dividends. They're required to pay out a certain amount of their earnings in dividends. But I still feel like the question, why should I own REITs at all, is still standing out there. Like, I know why I want these specific sectors, right? But I'm sure, and it's not even for me. I'm just certain that somebody's listening to this going, REITs? I haven't thought about this before.
All right. So, great question. So there's a book that I'm sure everybody's familiar with, at least they should be. It's called The Intelligent Investor.
Absolutely.
It's written by the legendary Benjamin Graham. And I give this to all of my kids. They all have it. I don't know if they've read it. I tell them they should. I reread it quite a bit, especially when I went through some very tough times, 2008, 2009. I read it multiple times because, Benjamin Graham went through some tough times. So did
his
Warren
books
Buffett.
sell like crazy in crises.
Yeah, absolutely. And throughout this book, there's a common thread in almost every chapter. And Ben Graham writes about the margin of safety principle, which you all know is simply, we've got to buy stuff cheap, and we want to buy high quality goods at a cheap price. I want to buy a Porsche for the price of a Buick.
There you go.
And by the way, I just did that last week.
Nice.
Nice.
I'll save that for another day. But there's another book I wrote a couple years ago called The Intelligent REIT Investor. Here, it's available on Amazon. I use this book at a couple of schools that I teach out of, and it's more of a textbook. But the reason I titled this book The Intelligent REIT Investor is I try to explain, Dan, and to your point, the time to buy this great. REITs are a great vehicle. You have the dividends, you have access to real estate and all these property sectors. But if you really want to make money, and again, if it's REITs or anything, you have to utilize the margin of safety. And as you mentioned earlier, today, more than ever, you're seeing such a tremendous opportunity because of this negative sentiment that we're seeing. Again, rising rates and debt maturities and office buildings and all those things that are in the news every single day. But again, REITs. And again, the higher quality REITs, the ones that we think have durable competitive advantages. That's why we call our company Wide Moat Research. We want to see these companies, whether REIT or not, that have wide moat competitive advantage, scale advantages, cost of capital advantages, critical to those businesses. So when we select those high quality companies, and then we go to the valuation, and we look at multiple valuation triggers, not only just the traditional price to earnings or AFFO metrics, how do they compare against the peers or the other REITs. But we look at dividend yield. Is that dividend yield safe? I mean, just because a company is paying out a 7% yield, is it sustainable over time? We would like to see alignment with management, with investors. And when all those boxes are checked and we look at the valuation, we say, well, that company's cheap based on this metric and it's cheap based on that metric. Then we'll even go further into net asset value. And that's really looking at the company in a lot more granular level to determine what is, if you had to liquidate this portfolio today, what is it worth? And so looking at all those factors and looking at the valuation, that's when we see that margin of safety. So yes, today we're seeing a lot of REITs that are very attractively priced. I get the question a lot because a lot of people know me from REITs. How many REITs should you have in your portfolio? And I address that in the REIT for Dummies book. And the answer is it really depends on your risk profile. As well as I can't recommend to any listener, subscriber, customer what they should have in their portfolio because I don't know their portfolio. But what I'll say in general, very general, broad terms, I think it makes sense to have around 10% in your portfolio. If you're extremely bullish and you have that risk tolerance, I would say you could tap up a little further to 20% of your portfolio. There are also very attractive preferreds, which are less risky than the equity component. So maybe balance your REIT portfolio with equities, preferreds, maybe some bonds as well. And again, diversify. Diversification is really the best margin of safety you can get out, and so being able to diversify into these other property sectors I've mentioned. But I would say, look, now is from a valuation perspective, it's a very attractive setup. I do think with the new president coming in, President Trump coming in the office, I think certain sectors are going to benefit REITs better than other sectors. For example, what is tariffs going to do to the warehouse sector? And that's the sector we're looking at very closely to see what impact that could have on that particular sector. There are other sectors that I think are much more favorable categories. I love, I was a shopping center developer, so I love that. I love that business model. I mean, the great thing about grocery stores is everyone has to go to the grocery store once a week. So you see customers come in every single week. And typically, these grocery stores, and I like to see the dominant players, the Publix anchors, the H-E-B anchors, the Kroger anchors, those are very strong, the market leaders in those individual markets. I like to see them in the portfolio because they drive that traffic, which is why you see 100% occupancy or 95% occupancy in these shopping centers with Subway and UPS and very strong businesses. And I think with Trump in office, I think you're going to see a surge in small business growth. I really believe that, especially as it relates to some of the tax reform and extending the current tax credits now, or that Trump had initiated when he had his first term. So we'll extend those tax laws. We'll reduce the rates. I think that's going to drive demand, and also we'll say in terms of growth, I think you're going to see a lot more job creation. I think President Trump's going to be really focused on job creation. And I think that's going to really accelerate demand. And what I really believe we're going to see, his 4 years, I think, is going to be really good in general terms for REITs and commercial real estate in general. Although there are certain sectors that I mentioned, like warehousing, especially focus, say, in markets like California, that we're watching very, very closely. But look, I think now is a great time. You've got a president who coming in office who is very familiar with REITs. He's invested in REITs. You may not know, I wrote this book called The Trump Factor, which I published before he won the 2016 election. So I spent 2 years of my life analyzing his business. And he does own some REITs. At least the last time I checked his filings, he did own REITs. He actually is a partner with one of the larger REITs in some very large towers in New York City as well as San Francisco. So I think REITs in general are going to be very favorable set up with the new Trump administration.
All right. I know. I mean, I know that you've had a background in real estate. I think to me, you are sort of the REIT guy, but that's not all you cover in Wide Moat Research, is it? Wide Moat Research is exactly what the name suggests.
Yeah, I love how you landed in this area too, just by researching the companies themselves to be tenants and then applying that knowledge to stocks. I mean, it's kind of like a
Yeah,
no
you better be
brainer.
a good analyst then,
Yeah,
huh?
I agree. And look, I think,
Yeah.
I believe I have an advantage over other analysts because of my real estate background, because I understand how business is created from the ground up. Most every business that we cover, in fact, I would argue every business we cover has a real estate component. You know, we cover Target. Target owns a lot of real estate. In fact, I would argue if you look at the valuation on Target next time, I know they sold off considerably with the last earnings, but just go in that balance sheet and look how much real estate Target owns, and then calculate what that's worth, and it's worth a lot of money, and the share price doesn't reflect that, by the way. And but you can look at Coca-Cola. They own distribution centers. They lease distribution centers. They own corporate headquarters. They require real estate. Now, Coca-Cola couldn't operate without real estate. We could not conduct this call right here without real estate. Today, we're all at either homes or offices, but you have to have a piece of real estate for us to put a roof over our head. So real estate is a core asset class. But to your point, Dan, you know, what I've done is assemble over the last really 15 years, I've assembled a terrific team of other analysts that's going to help build and scale our business. 15 years ago, I heard about this guy named Dan Ferris and Porter Stansberry and the guys over at the Motley Fool. I used to write for the Motley Fool as well. And I thought, you know, these are some really good analysts. And I told Porter, first time I met Porter early this year in January, I told him, I said, Porter, you know, you're a mentor, and I'd love to be a competitor. And I said that very nicely to Porter. Obviously, I'm sitting here today because of that reason. And, you know, so we've been able to really tap into the network that I've created. And I've handpicked what I think is the dream team to help really build and scale, you know, Wide Moat, because I recognize that, you know, we can't cover I can't cover the whole world, but we can cover a lot of securities with our team. And so I've got an analyst, for example, and I think he is the absolute best business development analyst. He used to run due diligence for two very large companies, worked at hedge funds, he's CFA. You know, I just try to bring in the right talent and to really help round out, you know, our business model. So yeah, I think what we wanted to do is be able to offer a product where the individual investor could utilize our research to build an entire portfolio of what we refer to as SWAN stocks. That stands for Sleep Well at Night. And we think that's the key to the Wide Moat model. You know, I've lost a lot of money in my development career, and some of it was no fault of mine. Some of it was fault of mine. I picked a bad business partner. The great thing about public stocks today is that I can fire that management team with one button. I don't have to go through lawsuits to get rid of a manager. If I don't like that company, I just sell the shares and I'm out of that company. I don't worry about it anymore. And so, you know, principal preservation is really the key. That's our mantra is protect your principal at all costs. And that's something we really, you know, it comes from me from deep inside, because, you know, when you experience these painful losses, you don't want to see that happen again. You certainly want to see, you know, it happen to your customers. So, you know, we really do a lot of, you know, our research is really predicated on those principles. And we think, you know, fundamentals is what's going to drive the earnings of the company. And so that's where we think our advantage is really laser focusing on these company fundamentals and valuation. Again, the intelligent investor, that margin of safety is really critical for us. And buying theyese companies at the right price when they're on sale is really, really critical for us and for our customers.
I just want our listener to know, I know Brad's a value-oriented guy, but I didn't know he's going to wave the intelligent investor around. I'm just, you know, I've been a diehard value guy for years.
Yeah, not only that, Dan, I was looking at Brad on his website, his, you know, recommended reading list. He's got The Most Important Thing on there by Howard Marks as well, Dan. So you guys are book brothers, and me too. I mean, I like those books too, but Dan, you know, value guy for sure.
Yeah, Howard is on my bucket list. I'd love to meet him. I've got some real close connections to Howard, but I definitely think he is certainly a second level thinker, as Mr. Marks would say. So yeah, I do like to read, and those Marx is certainly a intelligent investor for
So,
sure.
what do you like outside of real estate? Like when I think of certain businesses, I actually, when I think of you, and then I think, well, what might he like outside of real estate? I think of a business like Costco or something. It's just pounding out money year after year. It's a fantastic operation, and it's so consistent. One of the things I've emphasized especially in our extreme value newsletter, is the consistency of results. And Costco is a great example because all the margins are razor thin, but they are like clockwork, quarter after quarter and year after year. So that's how it does what it does. And anyway, what when you look outside the real estate world, I know you made a good point about everything having a real estate component, Target, Coke, whatever. But when you venture outside of real estate, what's interesting to you? What businesses are interesting to you?
Sure. Well, again, I like to look at trends that are going to allow the companies to generate, those sustainable profits. And you mentioned Costco is a terrific example of that. Except for valuation, I was
Yeah,
trying to pull up the share price, but yeah,
yeah,
everything's great about Costco, but the
yep.
price. But again, I like others. I mean, to give you a couple examples, like home builders. I mean, home builders, yeah, it's real estate, but it's definitely a much more volatile, sector. And we've done really well in the home building business. And I think that's an area that we really like a lot. Railroads is another sector that I think could be interesting. Shipping sectors. So again, having kind of a more broad assortment of those types of companies. I like retailers because again, I built for these companies. Costco is certainly a great company. Target is interesting. I mean, obviously with that, they've been under some pressure of late. We like to see those companies that, especially in the retail sector, that are going to survive. And interestingly enough, I mean, we went into kind of going back to what I talked about the malls. What really triggered our bearish call on malls prior to COVID was the fact that we covered the department stores. And obviously we saw, the potential bankruptcies of Sears. We watched that. Actually, a REIT called Seritage formed as a result of Sears, their real estate. That was when Eddie Lampert was I guess, running the company. But we looked at those retailers. We look at like the one again, going back to the outlet sector, which is really kind of a subcategory of malls. There's a company called Tanger Outlets, and what we did is I said, really, I want to understand, are those companies, going to keep paying rent? So we went into a lot of these retailers that are tenants of Tanger or Simon Properties, and evaluated them just like we would individual stock. And would we buy that company? And we want to understand all the fundamentals that drive those. So I think, breaking all of these businesses down has been really, we've looked at Kohl's, for example, is another company we've looked at recently in the retail sector. I like the insurance space. I think that's a great place to invest. And again, the master limited partnerships, energy sector. We've got an analyst who has a engineering degree, CFA, and he knows its energy sector in and out. So I think energy is definitely a place where we would like to invest capital. So I would say, broadly speaking, our coverage is roughly about 500 companies that we would like to at least cover on a regular basis. But again, that's not just the equity piece. There's a lot of those companies that have preferreds that are very attractive as well, especially in the financial sector. In the banks sector, for example, is one area I like. We are getting ready to launch a small cap product here very soon, and I think having a small cap, we were very successful with picking a lot of these small cap companies before they grew large, and still looking at some of those same competitive advantages we would see with those bigger caps. But we want to see those companies, they lack the coverage, and we feel like we could really help investors accelerate returns with a small cap portfolio. So that's something we're getting ready to launch.
Looking
soon.
forward to that. Yeah,
So I think
that sounds great.
Yeah, no, I'm excited. I think there's a lot of those companies out there, and kind of filtering through those companies and screening those companies. Again, using fundamental analysis is very important. And kind of going back to my start, I mean, when I started with my first company was Advanced Auto Parts, and they were they were not even publicly traded at the time, and that was a very successful bet for us as a tenant, because we were able to help the company grow and become larger, and eventually become listed, and all that. So. And I really love the auto parts sector. I mean, that's another space that, we think Advanced Auto's beaten down. That's not my favorite now. I think they've got some management issues, but we like O'Reilly Auto Parts. We like AutoZone. I'm actually fairly bullish on the dollar sector. I know there's been a lot of dollar stores built on about every block, but I do think that business model will be around for quite a while. And having built those stores, I understand where they're built, why they are. And so again, I think there's a lot of different stocks that we cover, and we just try to pick the best of the best. Again, with those quality metrics are extremely important for us. We're not market timers. We're basically buy and hold investors for the large part. Although when a company gets reasonably priced, we certainly look to exit those companies so we can reload and back into more attractive shares. So. Any rate, that's our business model. It may sound pretty boring, but it's very predictable, and really that's what I think investors really want is predictability, reliability, repeatability,
consistency,
and that's all important for us.
So Brad, you're my favorite kind of guest because I'm not the sharpest tool in the shed on my best day, and I can say anything and just sit back and watch you work for 5 or 10 minutes, and I love it, and I love having you here. But it is time for our final question, which is the same question for every guest, no matter what the topic, even if it's a non-financial topic, identical question. If you've said the answer already, by all means, feel free to repeat it. And the final question is real simple. If you could leave our listeners with a single thought today, what would you like that to be?
I would say this. My career has really developed as a lot of lessons learned, and when I was younger, I just did not really think about my mistakes and how could I learn from those mistakes. And the older I got and the more mistakes I had, I just I don't want to make those same mistakes again. And I think that's really the key is for me is, as I've grown and matured as a writer and investor, it's just, always try to, sit back and analyze, why did I make this mistake? If I recommended this company and it hadn't performed well, why is that? And did I miss something? Did Mr. Market miss something? And just trying to assess that. And, I've got, I mentioned earlier, I've got 5 kids, and, they grew up and they saw their dad, early on as a successful developer who was making a lot of money, and we went on a lot of nice vacations, and then they saw their father, lose all his money. And, again, some of it was due to, others, and some of it was due to me. And now they've seen me rebuild it. And I think that's really been important. I'm really proud of my oldest daughter, who probably witnessed most of everything, because she was older when she saw, us going to these really fancy vacations. And then when she was going off to college was really the toughest time for me. And I remember going on these college trips with her. She ended up picking a great school in North Carolina, University of North Carolina. And she followed, I wouldn't say she followed my footsteps because she did it all on her own, but she went to business journalism school. She's been at Bloomberg, she's been at CNBC, and now she's regularly front page at the Wall Street Journal. She is, I'm very proud of her, but she's learned a lot from, kind of what I've gone through. And again, I would say the biggest takeaway for your audience is, is always learning from those mistakes. And I try to exercise humility on a regular basis, if not daily. I don't, all of my calls aren't but I try to strive to, I want them all to be 100%. And the only way I'm going to do that is I'm going to learn from those mistakes and try to figure out, what I did wrong, what did I miss, and I think that's how I would take away is, and I think our subscribers and customers really appreciate the fact that that I'm trying to take my lessons learned into their life and help them build safer and retirement portfolios for them and their family.
All right. Learn from your mistakes. Good advice. Thanks for that, Brad. And thanks for being here too.
Enjoyed it, and look forward to seeing you again. And by the way, if I don't see you at the Christmas party or during the holiday season, wish you a happy Christmas. Merry Christmas.
Merry Christmas to you, Brad.
You too.
Thank you.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.